Right now, how about a single best chart? Let's go bigger and broader. Standard & Poor's 500 is a proxy for the market. We've shown this many times before, but really always needs to be said, and particularly with Brian Levitt, who with OppenheimerFunds has had the courage to be patient in international stocks. They were underperformers for a couple years. Boom, they come right in along with this U.S. chart that we see here. And there is just that massive impatience to go to cash. How do you fight that?
Well, you fight it by using a historical perspective to try and remind investors.
If you don't know the history, you can't play this game.
You can't play this game. And if you look at any 15-year period across markets, start at any month, look at any 15-year period, equities are positive 99.8% of the time. Stocks beat bonds 85% of the time. And yet investors remember the big drawdowns and they want to not experience them, so they avoid the upside. What
is the linkage, correlation, touch at the hip of international blue chips and U.S. blue chip multinationals? If Total of France goes up, does ExxonMobil go up as well?
Well, not necessarily. I mean, you have seen correlations regionally increase over the years as they've become more investable and as investors have swung in and out of portfolios. But if you look at the last 8 years, you had a significant outperformance from the United States for good reason. The U.S. had better policy coming out of the financial crisis than the developed world, particularly Europe. And the emerging markets suffered from higher inflation rates and tighter policy in the U.S. That's now reversed. Inflation down in the emerging markets, the U.S. Taking a more gradual stance, and the emerging markets doing quite well, especially once their currencies got beaten up last year.